If you own a business, please understand that there will be very little you can do to reduce your taxes after December 31st. If you do absolutely nothing before this year ends, please do not get mad at your CPA. Do not get mad at your tax preparer next tax season. Be mad that you did not implement proactive tax strategies to reduce your taxes before the year actually ended. And believe it or not, right now, there are still a ton of things you can do to save a lot of money in taxes and create a better outcome for yourself right now. So as a licensed CPA that tax plans every day at mycpacoach.com, I want to help you with this by going over my list of top year-end tax strategies for business owners. If that sounds good to you, please like and save this video, drop your thoughts and questions in the comments below, and get ready to save some more money in taxes. Okay, so let's start with our lowest hanging fruit, and then we'll get to some more advanced stuff. So the very first year-end strategy I would consider as a business owner is number one, prepaying expenses. Most business owners pay taxes on a cash basis, meaning they report income when the cash hits their account and they deduct expenses when cash leaves their account. Which means if you prepay your expenses right now for the next tax year, before this year ends, you will instantly reduce your taxes for this year. For example, let's say you expect to have about $10,000 of expenses next year for things like subscriptions to services or software, supplies and tools you need to run your business, or even professional fees to your lawyer or your CPA. Well, if you pay for those expenses before the year ends, you will be able to write off the full amount on your taxes as an expense as a cash basis taxpayer under IRS rules. The same applies to this second strategy here, which involves number two, delaying income. Now, I'll be honest with you, I am the type of person who prefers to get paid sooner rather than later, but occasionally at the very end of the year, I will take advantage of opportunities to delay my income into the next tax year to reduce my taxes. And to illustrate this, I want you to consider this scenario. So let's say right now you have a $15,000 check on your desk and you can either deposit it on December 31st of this year or January 1st of next year. And the question here is, which one of these deposit dates will save you the most amount of money on taxes this year? Well, remember, as a cash basis taxpayer, if that check is deposited on December 31st of this year, then it will be included in our income for that year as well, which increases our taxable income by $15,000. But if we just waited one day, we could defer that income by 1 year because then it will be included as income for the following year's taxes, not this one. Now, are we avoiding tax completely on that income? No, we're just kicking the can down the road here. But doing that may allow you to keep more money in your pockets right now that could be reinvested back into your business, other investments, or other financial needs. So if you find yourself at the end of the year with an opportunity to time your invoices, your deposits, or your customer receipts in a way to delay your income into the next tax year without any risk of collecting it, of course, then you might want to consider this. But let's go beyond these simple timing strategies and talk about much bigger items here that may move the needle a little bit more. Like number three, buying depreciable property. Now, if you don't know what depreciation is, it is simply a non-cash expense, okay? Meaning it costs you no additional money out of your pockets. And the IRS allows you to deduct this against assets that you use for your business. Some of the biggest tax strategies you will ever hear about will almost always include some level of depreciation.
A lot of my write-off was depreciation and other things that Hillary as a senator allowed.
Back, I said, hey, what if I bought a jet? Well, that'd be ridiculous. If I buy this jet, can I write off my entire tax bill? He's like, actually, that would work.
People buy real estate for the depreciation. They write off new vehicles they purchase through depreciation. They expense 100% of certain equipment and other assets they buy, even jets apparently, through depreciation. And these benefits are even greater now because depreciation tax deductions altogether just increased due to the most recent tax legislation that passed. Bonus depreciation is now 100%, which means that you can expense up to 100% of tangible assets you purchase for your business. So if you own a business and you're considering this, how exactly should you go about it? Well, as a CPA, I can tell you now, I never advise my clients to buy things they don't need just to save money on taxes. That almost never ends well. What we usually look for are strategic asset purchases that they can make that make sense for the type of business they run and actually helps them make more income through their business at the end of the day. For example, a truck driver might be able to increase their income by purchasing their own truck instead of leasing one. An e-commerce business might buy their own warehouse or even create space in their home to store their products and inventory to claim depreciation against that space. Doctors, dentists, and other service providers might buy equipment they need to provide certain services, which also increases revenue for their business. In almost every type of business, there are usually opportunities to make strategic asset purchases that may enable you to increase your revenue while decreasing your taxes through the use of depreciation. And by the way, I have several in-depth video guides that cover depreciation in detail on this channel, so just comment depreciation if you want to learn more about that. But for now, let's go ahead and move on to our next strategy here, which is number 4, reinvesting into your business. So buying property is not the only way to reinvest in your business or reduce your taxes. When I first started in business, I did not have money to buy property. I needed to spend my money on marketing my business, hiring the best employees, researching the best products and solutions, and so on. And guess what? All of those expenses are also 100% tax deductible. And in some cases, it might even qualify for tax credits like the R&D tax credit, for example. So if you find yourself with excess income as the year winds down, think about strategic moves you can make that will grow your business while creating tax deductions at the same time. But what if you don't have the time to start actually incurring those expenses before the year ends? Well, in some cases, adding a C Corp to your business structure may help when you have future reinvestment plans for your business. Now, most tax professionals scare their clients away from using C Corps, but they are perfect for reinvesting funds back into your business. C Corps only pay a flat 21% tax rate, and you are not double taxed when you leave reinvestment capital in your C corporation. Just comment C Corp if you want to learn more about this specifically. But for now, let's move on to our next year-end strategy here, which is number 5, using tax sheltered accounts and structures. Okay, so by now we have looked for opportunities to create deductions in our business, either through accelerating expenses or reinvesting back into our business in some way. Now let's assume that we're tapped out of what we can do in our actual business and start to look beyond it. This is where we look at making investments outside of your business into things that personally matter to you, like your retirement, health, charitable giving, and so on. There are several tax advantage accounts and structures that you can set up around these things that may allow you to shelter large portions of your income into it that in turn reduce your taxes. For example, many business owners set up self-employed retirement plans like SEP IRAs, solo 401ks, and even cash balance plans to set a huge chunk of their income aside for retirement while also preventing that income from being taxed. You can also shelter income into things like a health savings account, for example, which allows you to defer your income and even pull money out tax-free when using it for qualified health expenses. If you're a big giver, you might benefit from setting up your own private foundation or donor advised fund and sheltering some of your income into that structure as a way to reduce your taxes as well. Some people even use real estate investments as tax shelters. It is very common for real estate investors to park portions of their income into investment properties, which in turn offsets their taxes due to the depreciation benefits. The bottom line here is that if you have excess income that you do not want to pay tax on, you need to think about ways to shelter it from being taxed in the best manner possible. And if you need help implementing a tax plan that is guaranteed to reduce your taxes, just apply to work with my team today at mycpacoach.com.